And so in this video, I'm going to talk a little bit about liquidity ratios. So the two liquidity ratios that I'm going to focus on today are the current ratio and the quick ratio. So for the current ratio, we take current assets and we divide it by current liabilities. And in the formula, I have a little subscript T, and that's to denote that I'm using the current assets from a particular point in time divided by the current liabilities at that point in time. So if I had $2 million of current assets, $1 million of current liabilities, the current ratio would be 2. And the idea behind the current assets is current assets are things that you expect to be able to convert to cash within about a year. And current liabilities are things you expect to generally have to pay within about a year. So if I'm looking at the current ratio, basically what we're examining here is what I have that I think I can turn into cash that I could use to then pay off things that are soon coming due. And so the higher the quick ratio or current ratio is, the thought is the more able I am to pay off the debts that are coming due. Now, that doesn't necessarily mean that all current ratios are created equal. So if you think about the fact that I have current assets over current liabilities, um, current assets, let's talk about that for a moment. Let's suppose I had two firms that had both had a current ratio. Well, let's say I had two firms. One has only cash as a current asset. That's it. No inventory, no receivables, nothing, just cash. That's it. So if they had $2 of cash and they had $1 of accounts payable, no other current liabilities. So I would take 2 over 1 and I get a current ratio of 2. Well, let's suppose I had another company, a second company, company B, let's say. And for company B, let's suppose that they have $4 of inventory and $1 of accounts payable and no other current assets, no other current liabilities. In that case, company B would have a current ratio of 4. So if I'm looking at those two companies, the first company, let's call it company A, would have a current ratio of 2. Second company, company B, would have a current ratio of 4. So technically, company B has the higher current ratio. But does that really mean that they're actually more liquid in a practical sense? And the answer is I'd argue possibly not, because for company A, the only current asset they have is cash. It's already cash. They don't have to do anything to convert it to cash. It's already cash. For company B, the only current asset they had was inventory, which means they're going to have to convince somebody to buy their products in order to raise the funds. So even though theoretically they have a higher current ratio, their practical liquidity may actually be kind of worse because it's not a readily accessible form. Even though it's a current asset, it's still something that they have to sell to somebody. Somebody has to buy it in order for them to get the cash that they could then use to pay off the current liability. And so my point in saying that is to nudge you towards the idea that don't just blindly compare current ratios between firms. That's a first step to look at it and say, okay, this firm is higher, this firm is lower. Think about the context of the business, what kind of products they have, what kind of target market they have. Does that explain why they should have different current ratios, perhaps? But then the next step is to look at, well, let's look at those financial statements. Let's look at that balance sheet and let's see what kind of current assets we actually have and what kind of current liabilities we actually have. For instance, on the current liability side, what if a company had issued 40-year bonds 39 and a half years ago? Well, if they issued 40-year bonds 39 and a half years ago, then those bonds have 6 months before they're coming due, which means they're now going to show up in the current liability section, which is going to kind of smush my current ratio down quite a bit. Now, that's still relevant to be thinking about, well, they got this debt that's coming due and we're going to have to pay it in some way. So I'm not saying you should ignore the fact that it's pushing the current ratio down, not hardly, okay? But what I am suggesting is that's a little bit of a different situation. And I think you would need to evaluate the extent to which that's more of a short-term scenario because the bonds happen to be coming due compared to that might, maybe a normal situation where the company had a lower current ratio. And it would raise questions. Maybe they don't typically have that, so no, their current ratio is normally better. Now they got all these bonds coming due. They've popped up into current liabilities. It's tanked their current ratio. Well, that's a valid question. Are they going to actually be able to successfully pay this stuff off or not when this comes due in the next 6 months? That's an appropriate question to be asking and something you'd need to evaluate. But that means you had to do a little bit more digging to kind of get to that to assess, what's the interpretation of the ratio. So all that to say, basically, you really do have to look at the context a bit when you're making comparisons in terms of what kinds of companies and things like that. Also, look at what sort of account items are making up the underlying current assets and current liabilities, because that affects your interpretation of the ratio. Though all of these things kind of matter. And let's kind of talk about the quick ratio for a moment, then I'll make a kind of a broader point. So for the quick ratio, the idea behind the quick ratio was we're going to take the current assets and we're going to subtract out the inventory. So let's talk about that for a moment. The logic behind this is that the inventory is probably one of the least liquid current assets that the company has. Basically because for the inventory, they have to convince somebody to buy it before they can liquidate. And if you go into a recession, for instance, and you're an economically sensitive kind of a business that people just don't buy your stuff in a recession, that's going to be a problem. So the idea behind the quick ratio was, well, why don't we strip out the inventory? Let's just pull that right out and see how well could the company pay off its current liabilities using current assets excluding inventory. Okay, so the whole point of the quick ratio is let's pull inventory out of the picture. What can we do? Can we pay this stuff off or not? Now, that brings up an important point. A lot of students that I've had in the past have looked at this ratio and thought, oh, change in inventory changes the quick ratio. No, 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 no. Let's talk about this. The whole point behind the quick ratio was that we have removed the impact of inventory. And the thought is like, well, what do you mean? It's got inventory minus inventory right here. Okay, so let's talk about this. Current assets. This is the total current assets at time t. Total current assets would include inventory, but then I'm subtracting inventory. So if you expanded this current asset figure or to include all the separate items, cash, marketable securities, accounts receivable, inventories, whatever other current assets we've got, if you wrote all of those out individually, and then you looked at the fact I have this minus inventory over here, inventory is going to drop out. It's going to cancel out, and inventory would not be in the formula. And basically, you'll be able to see the inventory is gone. It's not affecting the ratio. So the whole point of the quick ratio is we have removed the impact of inventory. So important little note. You know what doesn't change the quick ratio? A change in inventory. Okay. Now, that brings up sort of another related note. So if I look at these two ratios, the only difference is that the quick ratio has removed the effective inventory. So what that means is if my current ratio is up here, my quick ratio is below it. It has to be. Basically, there's one little caveat, one exception. Okay. The one exception would be if the firm had absolutely zero inventory. If they had absolutely zero inventory whatsoever, then the current ratio and the quick ratio would be identical. But most of the time, businesses don't have absolutely zero inventory. So if they've got any inventory at all, current ratio is going to be here. Quick ratio is going to be something below it. Okay. So the quick ratio has to be below the current ratio. And I'm mentioning this because if you calculate financial ratios for a company and you're telling somebody, oh, the current ratio is 2 and the quick ratio is 5. No, ooh, something is wrong. Something is very wrong because the quick ratio cannot be higher than the current ratio. At best, at highest, it could be equal to the current ratio. And that would only be true if the company had absolutely zero inventory. So if you have gotten a quick ratio that is higher than the current ratio, you are for sure doing something wrong. Okay. Now, what you can then look at is the differences between the current ratio and the quick ratio. So if I'm looking at the current ratio and the quick ratio, the size of the gap gives you an idea about the relative proportion of inventory in those current assets. So if you've got the current ratio up here and the inventory and the quick ratio is way down here, what that really is telling you is inventory is making up a big chunk of the current assets that are composing up the current ratio. Because if I had no inventory, they'd be the same. So the further apart they get, the bigger the proportion that inventory is making up of your current assets. Okay, the closer together they get, the more inventory is not making up the current assets. And significantly, if I'm looking at them over time, if I examine the current ratio and the quick ratio over time, and the current ratio is going one direction and the quick ratio is going the other, that means something is going on with inventory because the only thing that is creating a deviation between the current ratio and the quick ratio is the fact that the quick ratio doesn't use inventory at all. Okay, so something is happening there. that is producing this effect. So maybe it's a situation where um, the company is drawing down on cash and buying more and more and more inventory. So the quick ratio is going down, not because inventory is changing, but because they're drawing down all their cash. And because they have perhaps built up more and more and more inventory through other means as well. Or perhaps maybe they did nothing else total. They just drew down cash and bought inventory. The current ratio would basically be unaffected, but the current ratio would be unaffected, but the quick ratio would go down basically because you have less and less and less cash, right? So it's not the change in the inventory that would be affecting the quick ratio. It would be they took a bunch of cash and bought inventory with it. Now we have a whole lot less cash. So if you start seeing changes in differences in the trends between the two, that indicates something is going on with inventory there. Now, at this point, I need to have a brief little comment about interpreting current ratios and quick ratios. So if you go online and you just start searching about current ratios and quick ratios, what you're probably going to find is some site somewhere that says something to the effect of the ideal current ratio is 2. That is rubbish. Okay, it's nonsense. And the reason why that's nonsense is because of the fact that what really matters is the kind of company that you have, the stability of the products and services and their associated sales and revenues, economic sensitivity, and so forth. So for instance, if I'm looking at a company like General Mills that sells like cereal, or maybe a Procter & Gamble selling toilet paper, toothpaste, all this kind of stuff, the sales for that tends to be very stable even in a recession. So in that case, they probably don't need a huge amount of liquidity on hand because they can count on sales coming in because the sales are very predictable, they're very stable, very consistent. And so they can probably count on cash coming in from their sales to help them pay off liabilities as they come due. Now, if I looked at a company that is much more economically sensitive, so if I'm looking at an auto manufacturer, when you're in the middle of a recession, people tend to not buy new cars. So if I'm an auto manufacturer, I probably need to have a much higher level of liquidity. If I'm an auto manufacturer and I had the level of liquidity of a General Mills or something like that, that might well be cause for concern. So and if I'm a startup company and it's really questionable whether people are going to buy my products or services, I probably need more liquidity and more cash. So what constitutes an ideal set of liquidity ratios really depends a lot on what kind of company you are and how stable the sales are, how economically sensitive, and so forth. So what that means is there is no ideal liquidity ratio. It does not exist. What matters is, do you have enough liquidity given your circumstances, your economic sensitivity, your stability of sales, all of those kinds of things. Do you have enough liquidity that you are in a financially stable and secure situation? All right, hopefully this video has helped, and thank you so much for watching, and have a great day.